Today, we're going to dive into a massive financial deal that could completely change how millions of us think about our single biggest asset, our home. I mean, if you're a homeowner, the answer is probably a big yes, right? You've got all this value that you've built up over the years, but so often it just feels trapped. Like there's literally cash sitting inside the walls, but you just can't get to it. And we are not talking about chump change here. Right now, the amount of equity that homeowners can actually access is near an all-time high. It's a massive, massive pool of wealth that a lot of people are looking at, wondering, how do I use this? But here's the catch, right? At the exact same time that all this home equity is piling up, so are the costs of just living. We're talking credit card debt, car payments, you name it. It all adds up and puts a real financial squeeze on so many families. So this leads us to a huge dilemma. You've got the wealth, but the usual ways to get it, like a loan or a home equity line of credit, well, they mean taking on more debt and another monthly payment. And that's the last thing a lot of people want right now. And you can see this in the data. A recent survey found that 60% of homeowners said that just having the option to tap into their home equity gives them a huge sense of financial security. It's not just about spending the money, it's about the peace of mind. And that really is the multi-trillion-dollar question. Is there a way to get that cash in the walls and give yourself some breathing room without the burden of new debt? Well, it turns out there's a financial tool that's gaining some serious momentum. Okay, so this is where something called a home equity agreement, or an HEA, comes into the picture. And it's designed to solve this exact problem. Now, the most important thing to get here is that an HEA is not a loan. You're not borrowing money. Think of it more like a partnership. You get a chunk of cash today, and in exchange, an investor gets a share of your home's future change in value when you decide to sell down the road. So how's it work? It's actually pretty simple. Step 1, you get a lump sum of cash. Step 2, and listen, this is the real game changer. There are no new monthly payments, no interest charges, nothing. And then step 3, way down the line when you sell your house, the investor gets their original money back, plus a slice of the appreciation that you've agreed on beforehand. Now, for a while, HEAs were kind of a niche product, but that is changing, and it's changing fast. In fact, a huge recent deal shows that some of the biggest players on Wall Street are really starting to pay attention. A fintech company called Unlock Technologies just did something pretty amazing. They bundled up a whole portfolio of these home equity agreements and sold them off to big institutional investors. And it's the sheer size of this deal that's making everyone's head turn. The total value, over $303 million. So yeah, this was no small experiment. This was a massive transaction, the company's biggest ever, and a really clear signal that this market is starting to grow up. But get this, here's the really wild part. Investor demand for this thing was through the roof. They got over $1 billion in orders. It was massively oversubscribed, which means way more people wanted in than they even had room for, including a bunch of first-time investors. But maybe the most important milestone of all was this. The deal got an industry first. The biggest, safest chunk of these agreements earned an A low credit rating. Now, if you're not in finance, think of that like a giant seal of approval. It's the financial world saying, okay, this isn't some quirky little product anymore. This is a stable, reliable investment. So what they did was slice the deal into different layers, kind of like a cake, based on risk. That top, safest layer, worth over $167 million, that's the one that got that strong A rating. And by structuring it this way, they made it appealing to all kinds of different investors, from the super cautious ones to those willing to take on a bit more risk. And as Timothy Carr, the CIO at Salutigrade, the company that sponsored this whole thing, put it, this rating demonstrates the confidence institutional investors have. It's a huge signal that HEAs have officially arrived on the main stage. Okay, so a massive deal and a big shot credit rating. That's great for Wall Street, but what does it actually mean for the rest of us, for you? Well, this is where the story gets really good. What we're seeing is the creation of a real win-win situation. For homeowners, it's a way to get cash from their homes without going into debt, giving them incredible flexibility. And for investors, it's a whole new way to invest in the housing market that's tied to performance. When big investors get this interested, it means more money flows into the market, which can create even more and better options for homeowners.
And that really brings us back to the whole point of this. Like Unlock CEO Jim Riccitelli said, a deal like this just accelerates their mission to make it easier for people to access their home equity. At the end of the day, these huge, complicated financial deals are what make it possible for innovative ideas to reach more and more people.
So, what are the big takeaways here? Let's break it down. First, home equity agreements are a totally new way to get cash out of your home without that dreaded extra monthly payment. Second, this monster $303 million deal has basically put a giant stamp of approval on HEAs, proving they're a serious financial product. And third, all of this is fueling a growing market that looks like a win for homeowners and investors. Which really leaves us with one last fascinating question to think about. As more and more people look for ways to unlock the wealth in their homes without taking on more debt, could solutions like this become a totally normal part of how we finance our lives? This landmark deal suggests that shift may have already begun.